Hi, I'm Andrew Berman with the Mortgage News Network. You're watching Beyond Print. I have with me today John Su, who's the head of capital markets for Angel Oak Capital Advisors. John, thank you for taking the time out of your busy day to sit with us.
I appreciate you coming into the office.
So listen, and there's no question about it, you guys are insanely busy, doing a great job of providing unbelievably innovative products to our readers who are top originators. But I want to talk a little bit about some of the securitization that you guys have done. First off, regarding the differentiation between the different issuers, how are different sponsors approaching the non-QM securitization market?
Well, there are really two ways about going about doing this. One is really what traditionally has been in the mortgage market, which is an aggregator model, which right. You may not necessarily have an originator in-house, yeah. But you may be licensed, but you go out to other originators and you ask them to follow your origination guidelines and provide you product. Mm-hmm. That's the aggregator model. There's the other end of the spectrum is like a vertically integrated model, and this is the one Angel Oak follows, where we have an originator and we also have the capital to back that up. So the sponsor of the securitization is actually separated from the originator, but it's all part of the Angel Oak umbrella.
Interesting.
And sometimes you see hybrids there, but eventually they're going to go to one or the other.
So, can you talk a little bit about the details about the different securitization platforms and strategies that are being implemented today?
So there are really three types of strategies that people are employing today. One is a pure aggregator model where an originator or sponsor will buy 100% of the assets in the securitization from right. Third-party originators. There's a kind of a hybrid model where an originator has its own production and has its own sponsor, but they'll supplement their own production via third-party purchases. The way Angel Oak does it is a fully integrated model where 100% of the assets that we securitize come from our originator. We think that is a competitive advantage because when investors do diligence on the sponsor and therefore the originators, it's very easy to say, well, we only have one originator. It's very easy for us to check the reps and warrants to make sure that they follow the guidelines, legal guidelines, or regulatory guidelines. It's very easy for us to say that. So we think we get rewarded that in the capital markets.
Great. So, what does the securitization market look like? How many deals have been done?
It's a great question. So, the market right now is pretty healthy. It's still developing. Right. But we've done, in the marketplace, has done 16 transactions. Angel Oak has done a quarter of those. Wow. I think total issuance is just about $4 billion.
Wow.
And it's still a growing market because if you look at the non-agency market pre-crisis, it was probably north of $1 trillion. So this is anemic, but we're hoping to build that up very quickly.
So do you think we'll ever get to anything close to the numbers that we were having?
I think that 1.2 trillion was probably the high point, and probably most market participants can say that was probably too large, and that probably caused some of the problems. Yep. But even if you get to a much lower number, like a 200 or 300 billion, it's still well short of what we're doing today. And I think that number, the 200 to 300 billion, is a very healthy number when it comes to credit, like providing good credit. That's what the market wants, and I think there's so much runway to go that I think we can really reinvigorate the non-agency market at that level.
So who are the investors and buyers of these deals?
It's really the good news there is that there are hedge funds who participate, and they tend to be seen as like fast money. Yeah. But they do participate and they do hold. However, we see a lot of money managers, insurance companies. We're starting to see banks come in, credit unions. So these are really buy and hold investors, which really point towards the health of the marketplace, which we think is a huge positive.
So, has that changed? From when you guys were starting this?
Well, the change is that we did see probably a little bit more hedge fund participation, but I would say that the number of participants have grown steadily. Like Angel Oak, for instance, has probably more than 30 institutional investors that support our AOMT program. And I would suspect the other originators have the same number too. So it's really the growth of the market in terms of the number of participants that I think has changed. Plus the rating agencies getting involved, and as time goes by, more and more agencies get involved, which again, they're getting comfortable with analyzing the non-QM credit just like investors are. So I think that all that points towards a strong, healthy, recovering market.
So John, what needs to happen to develop the market further?
Excuse me?
What needs to happen to develop the
sorry.
market further?
Yes, I think what needs to happen is more transactions,
Right.
performance, of course. So the good performance really does bring investors in. People are a little bit afraid. You know, the non-QM was initially painted as the new subprime, which is incorrect. So performance, having competitors in the asset management business buy, and then other managers saying, okay, well, it's not so scary. Rating agencies getting more and more comfortable developing and refining their ratings process. All of those things will help. And then really what we'll show you is secondary market trading, which happens on occasion, but not as much as say strong primary markets are showing right now. But that will come.
Any other challenges that you guys face to continue to grow this?
Really, the biggest challenge is origination, believe it or not. It's not a lack of demand on the investor, the bond investor side. It's more of getting the volume through the door so we can securitize larger transactions more frequently. I think that's probably the biggest challenge.
Interesting. So how's Angel Oak approaching this market?
We're approaching the market from both ends. I think that's one of our advantages, that we have an originator that's affiliated with the asset management business, and we flow information back and forth. So when we do a transaction, we can talk to the originators and say, this is what investors liked or disliked about our transaction. Then we can also go, because we have the capital, we can go to the originator and say, are there any products out there that you would like to develop? And we can say, you know, can you change this slightly? Can you get more volume? So it's that free flow of information, I think, is really an advantage for us, that we kind of real time, and we can make changes very, very rapidly and make decisions rapidly and access the market quickly. So I think that's one advantage that we do, and I think that it helps us.
So you're having the dialogue with the originators that are out on the street, finding what does the market need, and you're connecting them to the money on that's coming in from Wall Street, and making sure that there's the funding for those different products.
Correct. It's like a bank statement program. We were able to identify what bond investors liked, rating agencies liked, disliked. We're able to bring that information back to the originator in real time. They were able to tell us what some of their challenges were, and we were able to refine the program to where now a very large portion of our origination is bank statement product.
Wow.
And now it's a very accepted asset class within the non-QM program.
So if you can talk a little bit about Angel Oak's investor base and really the plans for the future.
Well, our investor base is really from the bond investor side is, like I said, money managers. Yep. So these are big household names managing trillions of dollars individually. To insurance companies, we're very happy to see banks coming in. The fact that we use 2 rating agencies allowed banks to participate, along with credit unions. We're also seeing an expansion of our buyer base and bond investor base into Europe. So that's another thing that we see as a healthy sign, that European investors who were a little slower to the game are seeing the activity, seeing the performance, and recognizing this is a place they want to invest money.
Fantastic. So listen, there's no question you guys have a dominant position when it comes to the non-QM space in terms of both originations and securitization. What's to keep you guys from being knocked out of that space?
We ask ourselves that question all the time. I think really the key there is, because we're in a leadership position, it's really ours to lose.
Yeah.
So we feel that we need to come in every day and have, on the origination side, great volume, great relationships, of course, strong underwriting. On the capital market side, my team in securitization, it's communication with the investors. What we do is we go out there proactively, without a deal in hand, and go visit investors, go visit the rating agencies, give them insight as to what the market is doing, how we're seeing the market develop. And by that, that's how we stay competitive. We want to be the first person they think of when they think of mortgage credit, as experts in the marketplace. Wow. and a source of information.
Great. So listen, John, a lot of our readers are some of the top originators in the country. They want to know what this means to them. So I'm going to break this down a little bit to the originators that's out on the street that are either right now offering the Angel Oak product or not offering the Angel Oak product. What does the continued growth of Angel Oak mean to them?
Yeah, sure. So Angel Oak, to give a little brief history lesson, Angel Oak is a non-agency fixed income manager.
Right.
So really what we're seeing, one of our really fundamental thesis of Angel Oak Asset Management is the non-agency market must exist, right? Mortgages must exist. So what we're really providing is the new non-agency. And what I would say to an originator is, it's great to have your conforming program, but here's another program you can offer to your borrowers, to your referral sources, to have the most interesting conversation, because originators are competing for that one loan file. Right. And the ability to offer products, which you may in the beginning offer out once or twice a month, but over time you may see that that program is more and more utilized by your borrowers and referral sources. So, and also the competition is slowly adopting that as well. And so the more, and non-agency, is because it's a manual underwrite, it's very different, and the underwriting is not the same as conforming. So it takes some time to sort of get back to speed, get that skill set. Some folks may be rusty a little bit, origination and underwriting. So I think early adoption is good. Right. It gets more products. It gets the skill sets, back up and running as efficiently as the conforming product is.
Makes sense. Fantastic. Well, listen, John, I really appreciate you taking the time out of your day. It's very exciting what you guys are doing here. I know there's a lot of originators that are offering your product out in the street that are excited. Sounds like the investors are excited. Everyone's excited about what you guys are doing.
Thank you. We're excited too. It's been a multi-year program, and we're just seeing the beginnings of our success. We appreciate that.
Thanks. I'm Andrew Berman with the Mortgage News Network. Thank you for watching.
This is Mortgage News Network.